waiting for interest rates to drop before I buy.
I've heard this from dozens of would-be property investors over the past year, and to be honest, it's costing them hundreds of thousands of dollars. What if I told you that in 2025's market, waiting for the perfect interest rates is actually the riskiest strategy of all? Today, I'm showing you the math that proves why smart investors are buying now, regardless of what the interest rates are doing. Hey everyone, Aagam Jain here. I help busy professionals build property portfolios that actually create wealth. If you've been sitting on the sidelines, waiting for interest rates to drop before jumping into the property market, this video is specifically for you. I'm going to show you exactly why the wait and see approach to interest rates could be the biggest financial mistake you make this decade. We'll look at real numbers, real market data, and the strategy that my most successful clients are using right now. Let's dive in. Let's address the elephant in the room. Interest rates in Australia are higher than what they've been in years. The cash rate is sitting at 4.1%, with typical investor loans around to 6.2% at the moment. And yes, that's higher than the ultra low rates we saw in 2020 and 2021, where rates were like 2%. But here's what most people don't understand about interest rates and property investing. Misconception number one: lower rates equal better investment returns. The truth: there's actually an inverse relationship between interest rates and property prices in many scenarios. When rates were at historical lows in 2021, what happens to property prices? They skyrocketed. When everyone can borrow more, everyone pays more. It's that simple. Misconception number two: waiting saves you money. Here's the costly math that most people miss. Let's say you're looking at a $750,000 property with 20%, which grows roughly on average 7% per annum, which over 3 years would be around 21%. If you wait 12 months for a potential 0.5% interest rate drop, you save around $3,750 a year in interest, but you miss out on more than 50 grand in capital growth in year one. Plus you lose the rental income. That's a net loss of almost over 80 grand from just waiting 1 year. The math simply does not support waiting. Let's look at what's actually happening with interest rates in 2025. The RBA is actually taking a measured approach to any future rate cuts. Number two, not all banks are passing on full cuts to investors. And number three, global economic factors are creating ongoing volatility on what is going to happen in the market in the future. But here's what most people miss. Even if rates do drop, the market impact has already been priced in. Most people have been, in my experience, over the last 6 months, the investors have really just ramped up in buying because they know that eventually rates are going to drop significantly. However, that's when the growth is going to happen. But if they got in earlier, they would be able to get the properties at the cheapest possible price now compared to what they will be in 1 to 2 years when the rates have actually dropped. Other things are first home buyers are starting to come back into market because you only need as little as a 5% deposit. And all those investors that were waiting and fearful back in 2022 have now finally got themselves ready to buy 1, 2, or 3 more investment properties. And to be honest, the smarter investors understand this cycle. Everything is part of a cycle. When property prices go up, that's part of a cycle. Eventually they correct, then they go back up, and eventually they correct. It's the natural course of the economy. So what should you actually be doing about interest rates in 2025? Well, you should actually focus on the spread, not the rate. What does that mean? The real number that matters isn't the interest rate. It's the spread between what interest you're paying to the bank and what income you're receiving back from that property. So that's the spread between the rental yield and the borrowing cost. So if you're anywhere between 4 to 5 to 6 grand a year, depending on the loan amount that you have, and therefore 6 grand over 12 months is a matter of $500 a month. Generally speaking, most people can dish out an extra $500 a month with the assumption that, the rates are going to get better, and therefore this $500 extra a month is only temporary. Another strategy is that you can use certain loan structures to reduce that interest cost, such as number one, having maybe a part fixed, part variable split, where because the fixed rate is lower, you can have a lower interest rate on a portion of your loan, and you can leave a portion of your loan as variable just in case there's any future cuts, or if you have significant amount of savings that you can put in the offsetting account, which would therefore allow you to reduce your interest and therefore reduce that spread between the interest that you're paying as well as the rental income that you're receiving. The right structure can make you way more than waiting for a rate cut ever will. And lastly, buying in the right location trumps any interest rate timing. The difference between growth in a premium suburb versus an average one can be between 5 to 10% a year. That dwarfs any interest rate consideration. My clients who have bought in regions like Townsville, Perth, some regions in Melbourne, they have already seen over 12 to 15% growth, which completely offset any higher interest costs. Some of them even took lending from third-tier banks where they were paying anywhere between 0.5 to 1% higher. But that means they accessed 15% growth on a 5 to 600k property, which trumped any interest rate premium that they had to pay. Before I show you exactly how to implement this strategy in today's market, if you're serious about building a property portfolio regardless of interest rate cycles, I've put together a free interest rate proof investment strategy session. In this call, we'll analyze your financial position, identify the optimal loan structure for your situation, and create a customized property investment plan that works in any rate environment. Just click the link in the description to book a time. Now, let's look at how to put this into practice. Here's how to implement this strategy in today's environment. Number one, you need to understand your borrowing capacity. Not all lenders are created equal in 2025. Some are still assessing at unrealistically high serviceability rates, which means if you're paying 6%, they're assessing as if you're going to pay 9%. Whereas we know interest rates are sort of on the downfall, so they're nowhere near going to be 9% in the future. Other lenders have introduced more favorable investor policies where they reduce that buffer to maybe 1-2%, which allows you to borrow way more money. And that could be a difference of borrowing double what your major banks provide you at a rate only 0.2, 0.5, or maybe even 1% higher than what you'd be charged at a major bank. And most strategic investors understand that these third-tier lenders are temporary. Within 1 to 2 years, with the interest rates coming down, you may find that you can actually refinance back to these major lenders and reduce that rate. The premium of rate that you pay is simply temporary. Number two is buying in the right markets, buying in those markets which aren't already heated and reach their peak, but those in the early growth phases. For example, a lot of my investor clients are buying in Victoria because they know Victoria has been this huge sleeping giant that hasn't grown for the last 3-4 years due to the investor laws and taxes that have been applied. And identifying these suburbs or these areas and buying in them early can mean that in 1 to 2 years, you have a significantly higher equity position and you've outpaced any average growth that any other property would have. Lastly, structure for tax efficiency. Think long term, understand what the plan is, and what you may find with the right structure, you can claim more interest on your property by using strategies like debt recycling or borrowing against equity from your owner-occupied property. Secondly, you can utilize depreciation benefits to offset any holding costs as you can increase the deductions on your personal tax returns. And lastly, you can use certain structures such as company and trusts as a more long-term strategy where you're able to distribute the future profit that you make from these properties in the more tax-effective way, or perhaps even pass them on down to your kids. Let me show you a real example from one of my clients. Take Muhammad, for example. He was waiting for the rates to drop last year, but after we ran the numbers, he decided to buy the investment property anyway. The property he bought was around $520,000 in Townsville. He had put down a 12% deposit, meaning he only needed around 80 to 90k to cover all costs, including stamp duty, deposit, legal fees, as well as his buyer's agent fee. The interest rate that we got him was around 6.64%. The yield, he was probably getting around 6%. Now, it was costing him about 10 to 15k per year based on the initial numbers that he had done. Fast forward now, just 6 months ahead, that property has been valued by a major bank at around $650,000. That is a $130,000 uplift in value, and although it's costing him around 15 grand negative, and he could have waited and got a 0.5% or 0.25% rate cut. He's just made $130,000. And while that may seem as a once in a blue moon number, even if you were to make a little bit less than what he did, you would be making a lot more money and you would be able to buy another property sooner. So there you have it, why smart investors aren't waiting for interest rates to drop in 2025. To recap, number 1, the math simply doesn't support waiting. If you buy in the right area, the growth and income losses outweigh any interest saving. Number 2, markets move in anticipation of rate changes, not in response to them. Number 3, the right loan structure and lender selection is more important than the headline rate. And lastly, tax benefits can significantly reduce the effective cost for investors as they can claim it and potentially get a bigger refund back at the end of the tax time, at the end of the financial year. If you're serious about building wealth through real estate, the time is to act now, regardless of what interest rates are doing. Book a free interest rate proof investment strategy session with me where we can analyze your financial position, identify your optimal loan structure, and lastly, create a customized plan to build your property portfolio. The link is in the description below. Also, if you found this valuable, hit that like button, subscribe, and leave a comment letting me know what other property investing topics you'd like me to cover. This is Aagam Jain, and I'll see you in the next video.